Welcome to the video on Dehedge tools, which are the new tools in the terminal. You can find them in eTTerminal right here. So these are the Dehedge Levels and Dehedge Plus order book. Basically, these new tools are something that I introduced a week ago, and there needs to be some explanation as to what it is and how to use it. At this moment, for me, this is the most important metric that I'm that I'm watching from all of the tools in the terminal. And the reason for this is that the mechanics of the options market, specifically the SPX options market, has to be explained in two ways. So basically, the one way which you will usually see in different tools that are available, in the market, and also in literature, and people who are talking about it on on YouTube and on social media, is usually it is something like let's say let's go to options 88, and you will see that there is a price and there are some strikes, important strikes. So basically, let's say you have a strike with a lot of OI or a lot of volume, and these are, for example, calls, and these calls are in such and such quantity, or there is some kind of activity at that strike that it should work as some kind of a resistance for the price. Or if these are puts, then maybe and you can localize if these puts are bought or sold, so you can somehow quantify and estimate if this will work as a support. So basically, the standard concepts are that if there is some specific activity on the option chain and you add it on chart, you will get something like this. Or maybe you can quantify it somehow with things which are averaged down, and you will have something like this. So not just single strikes, but some kind of a standard deviation of expectations of options traders. Because, well, you have to understand one thing. There are two ways to approach this. The one would be market expectations, right? And options are actually great to figure this out. So kind of like a sentiment, and we are not talking about the dealer's hedging dynamics. We are just simply talking about the sentiment of the market based on the option chain. So basically, if there are a lot of calls bought on some kind of strikes, so let's say we have call and there, let's say it's 6,100, and this is the volume of this call. The other one, like let's say 95 strike, is much less. 05 is also small, and let's say you have a lot of gamma here, or maybe a lot of volume here, whatever. It means that there is some interest in this strike, right? And this interest is in some kind of way above average. And we have like many different metrics to to gauge that. We can use some Greeks, maybe we can use implied volatility for a specific strike, and this way we try to map these calls and puts, this option chain, and basically right, and basically try to gauge where could be the largest resistance or support. So the question is, okay, but the why would that be even possible for the market to stop or reverse at these levels, right? It's what does it mean that there is a lot of interest at some kind of a strike, or a lot of gamma, or a lot of delta, and so on. So like I said, we can measure these things and say that this is what the options traders expect, okay? And they expect, for example, that the price is going to get above this 6,100 because they bought a lot of calls there. So if the market is not gonna close, for example, at this expiration above it, they will lose money, right? And there is this statistical kind of reference point, or reference hypothesis, I would say, that the majority of option participants, retail participants, is losing money on options. Okay, so their sentiment shows us actually something which we can lean on, in sense of we can probably guess that market is not going above this 6,100, right? So basically, this is the way we are. This is the way we are trying to gauge the sentiment, but it's not like, okay, so there are much more calls bought, so the market is going to go up or something like that. It's more about what the market will statistically won't do, just because the interest there is too big. And this is one way to look at the options data. And obviously there are many different models how you estimate that. Again, I'm not saying that you should use volume or interest rate or open interest or gamma exposure. That is, a lot of different softwares is doing it in such and such way. Some are proprietary, some are well described. It doesn't really matter. What I'm trying to say, that it is one way to look at the options data. Now, the other way to look at the options data is the mechanics of dealers hedging. And this is widely known for like 2, 3, 4 years. So hedging, right? So what the hedging is? So what is the dynamic hedging? Dynamic hedging is connected with the activity of the dealers. So the dealers are, as you know, these guys who operate in a way that they are actually making a market, making the options market. So 99% of transactions that you're doing on options are with the other side of that transaction are the dealers. So they make the market. If you want to buy an option, they will sell it to you. Usually, this is a bit different, or completely different than futures market, where there is a matching mechanism and the order book and basically the brokers are matching. Usually, like in most cases, they're matching the order flow. They are not like in not the same sense. They are not the other side of the transaction. They are just the intermediate between buyer and seller. But with options, to be able to trade like we are able to trade on SPX, for example, SPX options, having all these strikes and all these expirations, there has to be a mechanism made possible by the dealers who are actually making the market. And basically what they are doing is they enable us to trade like in a very short period of time, in a very good price, at a very good price, with small spreads and so on. Usually on highly liquid stuff like SPX options. And the options market right now for indexes, and not only for indexes, is so big, and the volumes are so huge that this activity that the dealers are doing has more and more impact on the underlying market because of the way that they operate. And the way they operate is through hedging. So basically, in theory at least, the dealer, so the guy who sells you or buys options from you, their operational mode is they make money in theory just out of the difference in the spread and from the cost of transactions that you make. So they don't want to have the directional risk that you, for example, taking. And I'm not just obviously talking about the risk of direction in sense of the underlying asset. They also don't want to have the risk in the direction of implied volatility. So basically, they want to be delta neutral. And I'll do another video like introduction to how to understand the options market, like the basics of it, but not like what is call and put. It basically how it operates, why it operates like that. I think that the video like that would be quite helpful to majority of people who are dealing with options and options data and trying to figure out how to use it in your, for example, futures trading. But getting back to the point is that activity of these guys is getting more and more impact on the market, right? This is something that everybody agrees. So one way to analyze options data is gauging the sentiment, because options are the expression of the market participants' expectations, right? But these are specific expectations. These are not the same expectations as like a futures in a futures market, right? And we'll talk about it in another video too. But here is the other way that we are going to analyze options, and we are going to analyze it from the perspective of the dealers, or rather their impact on the underlying price. Okay, so in case of hedging, or generally in case of dealers' participation and impact on the market, we can see two ways of how they interact with the market. The one is through hedging. So whenever they sell an option, for example, let's say it's a call option, right? So their net position would be short, well, because they sold you call. So you are buying call because you think the market's going to go up. So if they sell you that option, they are short the market, right? So this is you and this is the dealer, right? So because the incentive is to stay neutral to the market, they have to hedge this position that they just established. And they can do this by, for example, buying futures, right? So suddenly, because they sold you the call option with their way of calculating the risk, they bought this on the futures market. So you bought the futures market and they bought it, right? And this way, they put a bit more pressure just by hedging your buy. They put a bit more pressure to the upside, right? So their activity by hedging is basically increasing the impact of the market going higher. Or if this is like the call situation, right? Call situation. Well, in put situation, when they sell you a put, right? So you are trying to go short the market by buying a put. So they have to hedge themselves by selling futures, right? Because their position is opposite to your, because they sold you put, so they are net long. And to neutralize the risk here, they have to sell futures or in other way. But they have to somehow make this opposite hedging position. And obviously it's much more complex formula. How do they analyze this? So they are actually hedged and not like to have more risk than they should, etc. So that's much more complex thing to do when you're actually doing this operation. But the general description of it would be something like that. So whenever they hedge, they have this impact on the market, which will increase the flow of the orders that they are handling. So if there are a lot of calls being bought, they will, because they sell these calls, they will increase the impact of this buying, because they have to hedge themselves by buying this market too, right? So their hedging in some cases will increase the direction of the flow that is going on, that they are handling. Okay, so now the question is, okay, so what happens to the price of underlying asset like SPX or the SPX index futures? What happens with the price? So let's say we have trend move up, and then at some point there is a lot of calls again being bought, right? And the dealer has to hedge it. So what it will do, it will strengthen this move, right? So you will often see the price is slowly grinding higher and higher. And the higher it goes, the more they have to hedge, pushing the price higher, right? So that is the one way that the hedging can impact the markets. And it happens a lot. So if you are looking for levels on your options through any formula that you're trying to estimate, well, you have to understand, what are you actually looking for? Are you looking for these levels or areas or situations or flows or whatever, which will strengthen the trend or the flow that you are seeing in the option chain? So are you looking for hedging flows, or maybe you're looking for something else, right? And that is what you usually get in these software, that there's a lot of different ones, but these are usually calculating the GX, right? So they are not like bad options. I mean, bad tools or something like that. But sometimes what I've noticed is that it doesn't really recognize what are we dealing here with. Are we dealing here with, I don't know, like the hedging here, or maybe something different? Because if there is an important strike here and price approaches it, I mean, are we going higher because of this strike, or are we going to bounce off of this strike? Or of course, it's just a probability, but we need to understand, what are we looking at, and what are the probabilities based on these things, like logically, right? Because if they are hedging here, most likely this price will like slow down a bit here, but then it will start grinding higher, right? Okay, so what is the opposite situation? The opposite situation is basically the de-hedging. So the way that the dealer is going to impact the price in opposite direction. So in opposite direction, right? If you can recognize this level here, this strike, or this area of strikes, right? So more strikes than one. And if you can recognize that this is going to be a situation when price gets here, the dealers will have to de-hedge, so start to wind down their hedge. They will impact the price in the opposite direction, right? And these are the new tools which are in the terminal here. So the Dehedge level are, so basically these are the most significant areas where it is highly likely that the dealers will have to de-hedge their position. So it will have the impact on the market opposite to hedging. So it will be against the current flow. So if market goes up and it starts to getting into the this area where dealer has to de-hedge, the price should at least stall or even oftentimes reverse because of the flow from the dealers. Okay, now important thing to remember, there are a couple points to remember here. Before the RTH opens, so the regular trading hour session begins, one of the largest, or many times the largest flow that there can be, are actually the dealers. Because the volumes are much smaller than during RTH, if something like this happens in ETH, so in overnight session, specifically in Europe during European session, so the one before a US session, and if these algorithms from dealers are going to fire up, it will have a much bigger impact on the price, because they will basically move the market. And I will show you on some examples how it behaves in the overnight session, in the European session, right? It's not that it doesn't work on RTH session, but you have to remember that RTH session is there's many more different flows coming in. The dealer's flow is still very, very important and impactful, and there's always a reaction in Dehedge areas, but it's not going to be as often as in overnight that dramatic. Like if price gets to these areas in during European session, usually it will provide like a reversal, and many times for the whole day. Like you will see that this is the high or low for the whole day. Okay, so let's get into the tool. So the basic setup of this tool, and this is like the most important setup. Like this is what I was trying to do. The simplest way to express it as possible. So these are just two levels. The levels in which is basically the violet line and the blue line. So resistance levels and supportive levels. The problem with this tool is that it's quite dynamic, and the whole point of my work was to, like last month, to get this thing going, was to find a way to get all this chaos into something digestible, because you could see it in the data, but once you try to visualize it, it's the patterns are like very obvious, but they are hard to visualize just because there's so much going on. But the pattern is definitely there, and for now, at this point, this is like the best I could come up with. This is a live chart, so this is from today, and not every day is the same. Sometimes it's much more like much easier to read. Sometimes it's a bit messy, but the way we read it, the way I read it, is always like the same. So again, these are just two levels: the support and resistance. Okay, how to gauge which is the most like important or the most impactful? Well, obviously the most impactful situation is when price comes into the level when it's still there. So basically you can see like this level here, which started at 18. So this is irrelevant because again we are looking at overnight, but probably more into European session. So when a European session starts, there is options trading also starting to go with some more significant volume. So let's say that from here, so from the morning, early European morning until now, we are like in 2 hours before US Open. So you can definitely see here, right, that the supportive level here at 6,381 ES, because these are all translated to ES. So you see the ES price here, ES, and the levels are translated to ES. Even though it's based on SPX options, right? So you can see that at this point, the most important support level is this one, because it's the most consistent one. You can see that it's like the longest one. We had some here, and here, but this is not relevant. The algo is like, it will show it, but it's already cleaned up, so it's easy to see which one is the most relevant support. So if at any point price would drop here in this area, an area is basically 5 points above this level and 5 points below, because these are not like single strikes. Okay, these are areas around a strike. You cannot calculate it or estimate it like with such precision, because this is not even based on one strike. So you have to have this margin of one strike higher, one strike lower. That's why we are 5 points higher, 5 points lower from this level. And you will notice that when price approaches this area, it will slow down, right? It will slow down because the dehedging starts here. This is like the critical point, but this dehedging happens here, right? It can even be like 10 points from this apex level, right? So this is where dehedging is going on. And let's say that a current situation, let's say that this is a mess for me. Like today the resistance level, so the dehedging at call side, right? So it's like maybe this, but this particular one is much more visible here, right? But yeah, so if price will get to this area at some point, then I would treat it as some significant dehedging area, right? Now, the longer it is absent, the less strength it has. So the probability that there will be dehedging is getting lower the longer the level is not there. So at this point right now, right, I would say that this area is right now, this is the most like consistent here. But again, that's quite a messy picture. I will jump into the previous days so it will be more clear and visible to you, hopefully. Let me take days before this. Okay, just before we go to this to the screenshots, I just wanted to show you the Dehedge Plus order book. This is the same tool as this one, so the levels are going to be totally the same, but they will have different colors. So basically, for the resistance, where is it? Okay, basically for the resistance you have red, and for support you have green. So I just decided to switch colors here so it's more intuitive. But as you can see, there are a bit more lines here. So in this tool, I just added the order book tool, which we'll talk in another video, and you know it well because it's been in eTTerminal for a long time. These are the levels where there is some way over average activity in options order flow, right? So basically the red and greens are the Dehedge levels, and it's combined with the blue supportive and violet resistive levels from the options cumulative order book. But because we are talking here about the Dehedge levels, I wanted to show you the other day. So this is the previous day, okay? And this is very important. So this is like the European session, right? Here is the start of RTH session. And you can see that for the majority of time, this level here, this area, this Dehedge area is there. And when the market starts and it starts to get closer to this, it disappears and it moves lower. It moves lower here. But that doesn't mean that there is nothing left here, that everything is dehedged. And this is like this very important concept, that this is the longest and most consistent area to this time, supportive area. Same as this one is the most consistent resistant area, okay? And because of that, even though it disappeared like 10-15 minutes ago, of course it's not going to be as strong as if it was there. But for me, that means that I can easily try to trade this, because the only thing that will happen here is either it will be a low of the day and it will bounce like here multiple times, so it will provide me with a lot of opportunities to scalp it, to trade it, whatever. But even if that would be a small reaction and a drop, because of the number of trading that was going on here, the price will always get back here, and then I can go out or do whatever I want to, to just have a break-even trade or whatever. I usually add here a bit and just scale out on the way back to this, because price can move lower or move higher. There's no like hard rule. The hard rule is that, let me explain how to prepare for this trade. Okay, let's erase this. So basically, I use like if this is the most consistent area that interests me, right? It disappears, obviously. Most of the times it will disappear just before price hits it. That's okay, because I want to trade it, right? I want to trade this area here. And like until 10 points, if this doesn't like go below the 10 points, below this level, like maybe 15 points, this is still in this area, right? This is still the hedging area. If it falls further, that's fine. I just, I can just add more here and get back and close out all my positions. Of course, if it falls like, I don't know, 30 points from this, then I'm definitely not gonna hold it anymore. But to be honest, it never happened. Okay, never happened before. So yeah, that's the basic way that I'm using it. And I'm not talking about the order book here. It's just I like these to be close to each other. Okay, but even without it, so even with just Dehedge levels, this is what makes it so strong. As you can see here, Like here is like a totally perfect situation because the level is still there. It's the same level as this, right? So this, plus you have the order book, right? And this is that rapid reaction. But one thing I would like to point out here, which is very important to me, I tend to stop trading using these options tools, specifically the Dehedge tool, like in the last plus minus last hour of session of RTH session, because this is where there is so much going on options, and there is a rolling to the other expiration and so on, and it's really sometimes it's really hard to grasp what's going on, and it's very chaotic, and usually this is when I make most of mistake, or I made the most of mistakes and bad trades. It's by the end of the session, right? So last hour, these options tools are not so great to me, but you have to observe it for yourself to witness that. Okay, I want to go through a few days with some examples. So let's go to the other day, the day before. So you can see like that's the perfect situation again, because you have this most consistent resistance area here, right? And it's multiple times attacked. There is also order book here, right? So you have 1, 2, so 1, 2, 3, 4, and then we are closing to this last hour of trading. The level disappears, it jumps higher, right? You had multiple occasions to trade it, but also the interesting thing is, even though that the level disappeared, right, and price kind of closed like above it, is like 10 points above it, the next day was a huge down day. Okay, so this is this is the next day. So these are the levels, right, where it closed, and it dropped like 70 points or something like that on the next day. Okay, so let's see the other day. Yeah, that's the other day. There's not much going on here. So we had like this level, then it became this level, right? So I wouldn't trade this even though it was close to it, but this level was quite consistent. The minimum of this was actually inside of it, but again, I wouldn't trade it because it's too late in the it was actually Nvidia earnings, so there wasn't trade for me. But again, if you would have to, if you would like to be aggressive here, like this is the level, this is the level, and this is the level, right? Or this here. Okay, let's go and see the previous day. Yeah, this one is actually easy also. So at this point, you could argue that this is early morning, the European session. So this is the first one. Obviously, this is the big one, right? And again, you had like scalping opportunities here, and this is where the last hour starts. So again, that's something I don't want to trade here. And usually when you see like when it's stick at this hour to this level, it's basically like 90% rule that it's gonna go right. It's not always, and I don't trade it, but that's how it usually behaves. Okay, let's go see another one. I want to show you just the as many examples of different scenarios as there can be. Yeah, this one is also easy. Like this is right, and even here you can see that it's below that, But at this point, the longest one and most consistent is this, right? So again, we are trying to go long here. And again, it's in European session, so it's basically a no-brainer, like just trade it. And then, there starts to appear this one, right? So it's best to just, close this trade. Then again, it's the end of the session, but again, you have this combination of order book and the Dehedge area, right? So it's something that definitely is you need to look at it for some time. You need to maybe study these screenshots, and I will add a zip file for you with tens of days with this tool. This is an interesting one, right? This is the one I wanted to show you. This is the CPI, I think. This is the CPI day. So what happened here is, as you can see, okay, we had a reaction here, right? We are reacting here, and even if you would trade the CPI, look what happened here. So this is our level, right? Our area, right? And it is broken, and it always gets back, right? It always gets back. You just get out here. I wouldn't reverse, like not just based on that, but this is what happens if it breaks out of this. And even though just before the spike up, the level disappeared, right? So it already told us, okay, so we have to be ready for this situation, right? If it disappears, it might have gone here, but you have to be ready for this situation, right? Let's see the other day. Not much here. Yeah, this one is actually also pretty simple, like you can see here, and then the end of the session again. This one is easy also, like this is the most consistent one, and it's got hit, so 5 points below it, so it starts to getting hit here, and it's just the top of the day. The 5 points plus the most consistent support, right? So it's something here, right? So it's just from top to bottom. So yeah, this is like a general description of how I use it. It's not like 100% automatic. That's why I'm still thinking about, okay, how can one automate it? Maybe put limit orders, but then there is this small part of how do you actually read it, and I hope I made it clear how one should read it. Okay, this one is good. Like the consistency is there. This is like over 2 hours, and this is the most recent one. Sure, this one is here too, but this one is the most recent one, and it disappeared just a few minutes before it was hit. Okay, right, and you have your trade. Usually these are going to be the highs or lows of the session, or if it gets stuck and it's close to like 1 or 2 hours before the end of the session, then I'll just take profit if I can and move on, right? The earlier it gets to that level, especially before RTH, the better. Because what will happen is that other traders are going to, so if there is a reaction in overnight, so in European session, the other traders, when US opens, will see that, okay, there is some significant volume here, there is some significant activity, so we will join this move. And what will happen is often it will produce the one-way directional day, right? So this also gives me sometimes a clue that we might have a directional day on hands. Okay, so that's why it's important here. Okay, so we are back at current situation. This is the Dehedge Levels with order book. So if we just go to Dehedge Levels, so in current situation, it's a bit of mess. And again, so far I would see that, okay, this is the level, right, for now. And probably right now I would already choose this one, because it already had this one big here. Then there is this one, but currently this is like the one most consistent, right? And for now, but even here, like these blocks, right? Even here you can see that there was a reaction here, right? Even though these were not the most consistent levels. So it's today it's a bit more messy on the resistance side, because support is rather well defined, right? Support is quite well defined today, because it's either this one or this one. I would for now I would choose this one, because this is the most current one, right? And it's consistent with previously most consistent one. I think I'm gonna still work more on these algorithm to like pick the one that is most important, which will allow some people probably to feel more like safe in picking up these things. But again, I think that this little part of, you know, a difference how you perceive it and understanding it, it's much better when you do it right by yourself, not by algo. There is already an algorithm which picks up these levels and stabilizes this model. But I'm still thinking about some automation here. So maybe there will be a version even more like stable, in sense of it just will show one level. I mean, two levels, for one level for support and one level for resistance, or not, or it won't show if it's not stable, right? So you can also find these levels. Where is it? In the study, in Sierra chart, right? So you could find it here. So this actually is a nice setup, right? Because we have our yellow triangle down plus blue anomaly, order flow anomaly, and we are here in this red area. So red area is basically this, right? And the violet is this is basically this one, right? This is 1-to-1 this tool. So violet is order book, and red is deleverage levels, right? And it shows the current ones, right? So it shows the current situation. So this is a combination of order order flow, futures order flow, these symbols here, and options deleverage situation. It unfortunately, I still struggle to make it record history. So now it shows what is right now going on. So history can be viewed in the terminal. So it will show you what it was like an hour, 2 hours, 5 hours ago. But in Sierra chart, you just see the current situation, right? The current one. Yeah. So this is the deleverage tools. It's very important. It's right now it's the best options tool in ET Toolbox for me, and obviously the other tools are also something that I'm watching on my left screen, because there are too many important setups there, which are, let's say, rare, but if they happen, they override anything else. So these are very powerful tools also. But this is like it works on a daily basis. Like every day, almost every day, you have like a setup here. These are part of the options analysis pack, and you can get it on emini.today website. And that's it for this video. In the next video, I would like to make this, what I mentioned at the beginning, a starter explaining options market, but in a bit different way than what I see on YouTube. So not explaining what is a call or put option, but more from understanding the data, the option chain, and understanding the basic concept of options in a bit different way. Like specifically, we'll go through implied volatility models, but not like complicated math. But I wanted to get to the very ground meaning of what it is and why implied volatility is like everything what goes around in options, and how everything else is connected to it, and how you can build your own tools and play with this data once you really understand what are you actually looking at. And maybe for some people who already know what the option is, what particular Greeks are, but they still somehow don't really understand how to connect all the puzzles, right? At least from my experience in talking to other traders, other people, the people are quite intimidated by the options data and options market also, and they try to stay away from it or use tools like my tools, and just don't give a damn about what it actually shows, just if it's resistance, support, and so on, right? So that would be the next video I really wanted to record. And until then, that's all for this one, and see you in the other one. Cheers.